This is the public transport system. Most of you take it to work. Every day, you take an hour of transport and jostle with other commuters just so that you can report to work on time at 9 a.m. For those of us who are fortunate, we work in comfortable offices. Some of us are not so fortunate. We work in hot and dirty environment, sometimes even working in dangerous places. When you are on a job, you exchange your time for money, doing things you do not like. At the end of the day, when recession comes and your company needs to save costs, they will fire you. Nobody is going to appreciate you for your hard work. That is exactly the reason why we need to make our money work for us. Money is the perfect worker. It does not need to sleep, it does not take any break, or needs to be paid any salary. It is constantly hard at work, making more money for you around the clock all year long. You cannot get wealthy by exchanging your time for money. No matter how hard you work, there are only so many hours in a day, and you cannot be paid for the time while you rest, sleep, and while you do other personal activities. Now, what if there was a faster way to wealth? What if you could make money work for you? What if the money can be a perfect worker? I have some good news for you. There are many ways your money can be put to work, making more money for you. While you report to work every day in your day job, your dollars could continue working non-stop in the background. Here are 5 ways that you can make money with money. The last method is my favorite. It has made me 6 figures, so be sure to stick around for it. Number 5. Business ownership. By having your own business, you can potentially make a lot of money. You may be thinking that you will need to put time and effort into the business, so it's not really a true making money kind of setup in that sense. And yes, you're right, I'm not asking you to spend time to run the business. There are ways you can start a business without having to run it. You can invest into a startup as a silent partner. You can have your active partner spend their time managing the operations while you simply be the guy who forks out cash. Of course, business is not without risk. Most businesses fail shortly after takeoff. You need to have the foresight to analyze the viability of each business you invest in. If you are interested in this area, there is a popular reality business investment show called Shark Tank. Do check it out for your own interest and knowledge. Number 4. Saving account with high yield. Most of us are unwilling to take any risk with our cash. If you're not willing to take any risk, you can consider a high yield saving account. A high yield saving account can act as a safe haven for your money. High yield accounts are backed by the bank and Federal Deposit Insurance Corporation, or FDIC for short. Even if the bank fails, you do not lose your money. FDIC will ensure you do not lose everything. As of 2020, FDIC insures deposit up to $250,000 per depositor, as long as the institution is a member firm. High-yield accounts pay about 0.5% to 3% depending on which country you are in. Although this is a small percentage, it's still much better than saving in your regular savings account, which typically pays less than 0.5%, and 0.5% is almost nothing. That makes high-yield saving account a good place to keep funds for emergencies. Keep in mind that online banks typically offer higher rates and better benefits on these types of accounts than physical banks. Online banks do not have costs associated with the brick-and-mortar institutions and can pass those savings back to you as a customer in the form of higher yield. It's a good idea to use high-yield account for your emergency funds. As you know, a typical emergency fund comprises of 6 to 12 months of your living expense. Keep your cash there and you'll be safe. There are, of course, certain limits for high-yield accounts. There's usually a minimum deposit requirement and there are some withdrawal restrictions. Number 3. Bonds. Do you have a car loan? How about a mortgage loan? Some of us might even have credit card loan. You borrow a lump sum of cash a few years back, and every month you have to repay that cash back, plus interest. It's not really a good feeling, isn't it? How would you like to reverse the situation? How about someone pay you lumps of cash plus interest every month? This is how bonds work. Bonds are a popular form of investing. A bond is essentially debt funded by an investor to a firm or government. A bond is issued by a corporation or government to borrow money from investors. Bonds are often issued by corporations or governments to support new projects or upkeep the costs. Bonds are used by some investors with the objective of preserving their capital while also earning additional income. Bonds are, in this sense, viewed as less risky alternative to stocks. When a company goes bankrupt, the company's assets are sold for cash. With this cash, as a bondholder, you are paid first before anything goes to the shareholders. Because of their lower risk, bonds are usually used to diversify a portfolio. When an investor buys a bond, they receive payment for the duration of the bond. The proceeds paid by the investor goes to the borrower. When the bond matures, the investor redeems it and the borrower returns the principal amount. This bond is a win-win situation for both the borrower and the investor. Bonds, like any other investments, are not without risk. The potential that the borrower may fail to repay the principal is one of the risks that bondholders face. This is referred to as default risk. Bonds having higher default risk often have higher interest rates to reward investors. The level of risk is determined mostly by the issuer's financial health. Most governments are typically regarded as stable borrowers and they are able to issue bonds with low interest rates because governments can raise taxes or print money out of thin air to repay the bond. Corporate bonds issued by companies usually have a higher risk of default because their business can fail and the company can go bankrupt. As a result, corporate bonds frequently provide higher coupon rates. Given these risks, please consider carefully before investing into bonds. Number 2, property. There are 3 types of property: residential, commercial, or industrial. There are a few strategies here. Firstly, you could buy a property and flip it around for profit. After buying the property, you can either fix it up yourself or hire a renovation company. To earn money from flipping houses, you must have an eye for detail. Buy a piece of property at rock bottom price and then restore or enhance the property. At this stage, you can either rent it out for passive income or immediately sell it for profit. You can manage the property yourself or engage a management service to take on the worry of being a landlord. Companies like Airbnb have made it simple for homeowners and property investors to rent their properties by catering to travelers. This is especially beneficial if your home is located in a popular tourist location. Many visitors prefer this compared to staying in a hotel because it allows them to experience the local culture. Property prices can be quite inefficient. Mispricing often occurs more often than not. This allows property investors opportunities to pick up properties at bargain prices. However, real estate investing requires significant amount of money. This forces most investors to have significant amount of cash before they can participate in the investment. It also forces the investors to concentrate their funds into a single investment idea rather than diversifying. If the property price falls, there goes your retirement funds. Before investing into a piece of property, be sure to have high conviction. Due to this, I personally do not like property investment, and this leads us to the very last type of investment which I'm going to talk about right now. Number 1, stock market. The stock market is my favorite method of investing due to how easy it is for me. Data is readily available, companies release their reports regularly and you are able to assess their performance. There is very low requirement to buy stocks into a single company. If you have maybe $10,000, you can easily split it into 10 different companies and invest $1,000 into each. This diversifies the risk. If one of those investments fail, we still have 9 other companies going strong for us. You should avoid market timing or day trading. If you day trade, you constantly have to monitor the market all the time. It is very stressful and takes a lot of your time. Leave that to the professionals. You are better off with long-term investment approach such as value investing. This also allows you to buy a stock, sleep on it, and wait for profit to come by. Because you do not need to monitor the stock market as much, this allows you to still keep your day job. If you do not want to pick individual companies, you can consider simply buying an index fund and dollar cost average into it. Every month, allocate a portion of your income and buy some of it. If the market goes up, you buy. If the market goes down, you buy it. There is really no need to think about it too much. Studies have proven that dollar cost averaging is a viable strategy in the long run. For me, I personally prefer to pick individual companies which are undervalued and mispriced. This, of course, requires a good amount of financial knowledge, but that's a story for another video.